Hello and welcome to another edition of Nucleus Investment Insights. We are all on board today with the Trump trade. Markets have certainly been moving in that direction over the past sort of 10 days to 2 weeks. And so I thought it was well worth jumping in and just having a look at what's happening, what are the pricings, what's happening in terms of pricing, what's happening in terms of fundamentals at the moment, what's running, what's not running, and what's being priced in, because it's certainly stock markets have very much taken the view, and actually most asset markets seem to be taking the view that Trump is likely to win. Having said that, there's a number of just weird things going on that I think are well worth noting and sort of highlighting in terms of and how that's going to affect sort of investment strategy and what's going on. So without any further ado, I just want to note as well that everything you hear today is not personal advice, so it's all general in nature. If you do want to have talk about your own personal circumstances, book yourself in. We can have a chat and run through what this might mean for you and your portfolio. So so the things I do want to talk about is the market's pricing and what's been going on. Some of the betting markets, what we're seeing there as well, that sort of maps in, and then running through what some of the big analysts, particularly some of the big brokerage firms, are saying, and then finally checking into sort of fundamentals and valuations just to sort of see where we're at in terms of those and how far ahead, I guess, markets have run. And so just to sort of give some indications about how much further can this go or not in various areas. So I just want to, I think probably the poster child for a lot of this is the DJT stock price. So this is Truth Social, and effectively you have to call it a bit of a meme stock. It just trades on a market valuation that's just way in excess of anything you can possibly justify from any of the fundamentals. And so, I guess the idea is this is sort of the, in the end, it's the way traders are expressing themselves in terms of saying, you can get some pretty good leverage in that. I've got a chart up to sort of showing the stock price of DJT versus the odds in the betting markets. And just over the last month or so, that stock price is sort of, up well over 100% as the betting odds have sort of improved from 45%-ish up to sort of 60%-ish, depending upon which sort of market you're talking about in terms of betting markets. So that's I guess the ultimate in terms of leverage for the Trump trade. It is worth noting though as well on that stock. There's sort of some weird stuff going on in the options market, and it's worth noting that in terms of people who are taking options bets on that stock, arguably the big option expiration date is November 8, is sort of just straight after the election. That's where you think most of the volume would be taken, but actually that hasn't been the case. It's actually most of the volume's out in November 15. And so what that's effectively saying is, in a way, is that the people who are making bets on this are actually betting that the election, there's a reasonable chance of not knowing who the winner's going to be, or to have certainly a lot of muddying of the waters in the days afterwards. And so they're basically taking the bet as, look, they're happy to pay up, I guess, and pay for that extra week in terms of the options market in order to make sure that there'll be a clearer picture about what's going on in terms of the election. So so sort of it's a little there's a little bit of a contradiction in that, in terms of saying, well, if you thought it was going to be a clear-cut Trump win, then you should know that by November 8. But the fact that that they've been pushed out that extra week sort of almost implicitly says, well, it's not going to be true. Even if you're expecting to win, it might not be a clear-cut win, and there might be sort of court cases and issues about voters and things like that going on. So so anyway, so that's the sort of the biggest place you can play it. There's lots of other places that this is sort of being reflected in. So the Trump trade, depends I think there's a number of places that are calling everything the Trump trade, despite whether it might make sense or not make sense. And so probably gold and silver is one of the key ones there. I'll get to that last actually, but I wanted to sort of the traditional ones you go is that DJT, the Truth Social. That's sort of like your reflection of what's happening. There are betting markets as well. Crypto is another big one. So if you think Trump's going to win, then he's made a lot of positive noises about crypto and what's going to happen there. And in terms of trying to reduce regulation, I think in terms of that side. US dollar, and so this is another weird one in terms of it being that you sort of he's spoken in terms of policies about having this idea that the US dollar should be weaker and that'll help US exports. But in the meantime, we've seen a lot of US dollar strength on the back of him, the expectation that or the changing odds that he's more likely to win, and that's probably really reflecting the higher interest rates. So we've seen that very much in the bond market as well. So we'll get that's sort of the second leg of it is this idea that look, if Trump gets in, we're in for higher inflation, and so probably higher and higher debt, and so higher bond yields over that time frame, which is why we're seeing that US dollar strength. Some of the other places we've seen small caps. So I guess this is an indication that less regulation. I mean, stocks in general are up, but small caps in particular over the last couple of weeks. Healthcare is probably not really sort of a Trump trade in terms of it being that the stocks are really going to benefit from a Trump presidency. More about they're probably going to there's more chance that they'll be punished under a Democratic presidency, and so it's sort of the absence of change, I guess, in terms of that. Energy, question marks on energy, and that's where we have actually seen in terms of the energy side that some of the stocks, in particular the energy services stocks, have actually been pretty weak. So notionally, there's this idea that if Trump gets in, it's drill baby drill, and so energy stocks are going to be better, and that's what's going to sort of help to drive markets higher. The issue on the energy side is that if Trump is out there actually drilling and lots more supply coming on, is that maybe that means lower prices. It's quite possible that Trump might push for fewer sanctions on Russian oil, which could see more Russian oil sort of return to the market. I guess his general views on wars and not wanting to be involved in wars probably says less happening in the Middle East in some ways. Potentially that though Iran is one of the countries he does sort of choose as a boogeyman. And so maybe there ends up, that could spiral out of control, I guess, what's happening in there. So energy is sort of this big question mark. I think in terms of energy production in the US, I would be certainly bullish in terms of that, in terms of saying, yes, there's more likely to be a greater energy production. The issue is, do you get oil price weakness that sort of means that the net effect for energy stocks is actually poor. Banks have had a big run up in recent weeks, and I guess that's a view that there's less regulation coming through from Trump, and I guess also a tacit sort of acknowledgement that the economy is probably going to be running a fair bit hotter under a Trump scenario, which might mean sort of concerns about bad debts or economic slowdowns are probably lessened for banking concerns or any of the banking concerns on that. On the flip side, this idea you want to be shorter bonds, so you want to be out of bonds to get that higher inflation. Now that's US dollar government bonds in particular. It's sort of this interesting part when it comes back to Australia insofar as Trump is going to be quite negative for China. And if you end up with a China that's sort of very much exporting deflation, got all these massive tariffs on it, looking at a very strong US dollar, maybe there's arguments that sort of that's the type of environment where you might expect interest rates to be lower in Australia. And so, but that sort of hasn't really been the case in terms of the way markets have been trading. Short renewables. This is another sort of interesting one, and so the idea here is that, look, if you're positive on renewables, then if you're positive on Harris getting in, then you buy renewable stocks, and if you're positive on Trump getting in, then go short the renewable stocks. This is the trade that sort of works more in the short term than it does in the longer term. So certainly during the last Trump administration, actually, some of the renewable stocks, that were some of our best performers. In particular, we were in some of the Vestas, some of the wind energy stocks, and actually as Biden rolled in, we got out of the stocks, and they actually haven't been a particularly good performer at all under sort of a Biden administration, and some of that's to do with the amount of renewables coming on from China. Some of that's to do with sort of some of the pricing we saw, COVID and supply chains and shortages. But I guess the net effect of that whole thing was, look, renewables are, there's certainly a policy expectation that'd be more positive towards renewables, but that doesn't necessarily mean that that the stock prices are going to move in that direction. And particularly, I guess the issues around China sort of says that, well, China is actually pouring a lot of money into supporting, whether it's solar or wind or anything renewable. They're sort of throwing lots of money into that and really ramping up production in China. If you got these massive tariffs coming through in terms of from Trump on everything coming out of China, then maybe that actually means some of the renewable players in the US and Europe are actually better off. That they're not facing that sort of competition, that sort of government-driven. Don't worry about profits. Just go for volume that you're getting out of China. So short renewables is probably that's not what I would want to stand in front of right now, but it's certainly one we're looking at as if Trump gets in, then and you sort of that sentiment passes or you get that price reaction in terms of pushing renewable stocks down, we'll certainly be looking at which ones we think could do quite well out of a Trump out of a Trump administration. Short Europe is another one that's sort of been running, and so short European exporters in particular. So that tends to be sort of Italy and Germany, but there's I guess within Europe there's certainly stocks within other countries as well that are affected, and the idea there is very much just on that tariffs, and that Europe, there's sort of won't have that same sort of close relationship with the US that they might have under Harris administration. Lots of question marks on tech. So the tech's sort of got these two edges to it. One is, okay, lower taxes, more chance at less chance of cutting up of closing the loopholes in tax that sort of help to drive it. More chance of some more growth under a Trump administration that sort of tends to be good for these tech stocks. On the flip side is quite possibly he's going to target some of them personally, with a view that there's if you're, say, an Elon Musk type person and you're close to Trump, you're likely to have tech policies that are going to be close to you. But if you're a tech company like an Amazon that might have Jeff Bezos owning also the Washington Post and some media that might have been quite negative on him, then maybe there's some retribution, so to speak, in terms of legislation or regulations that specifically targeted particular companies that he deems to be democratic leading. And so so tech's got that double-edged sword in terms of that. And then short Mexico is another one, quite a common one that we're seeing coming out that. Now, traditionally, you would have said Republican wins are better for defense stocks. They tend to spend more. That might not be the case this time. So it's quite possible that Trump win means less money spent, particularly in in Europe. Having said that, it's probably a positive for some of the European defence stocks. And so, whereas arguably you'd be looking at it, over the longer term, you say, oh, Republican gets in, that's a good thing for US defence stocks. Maybe it's the other way around. Maybe that's a good thing for European defence stocks this time around. And then gold and silver is a very much a weird one in that Trump trade, is that, we've got gold and silver hitting new records. Typically, you'd say if the US dollar is strong, then you see a weak gold price. Now, we've got US dollar strength, so the US dollar has been running up, as we spoke about. And so we've got both US dollar strength and gold strength at the same time, which doesn't happen very often. You then say, well, if you think real interest rates are going to be lower, that's generally a positive for gold. So gold doesn't have a yield. You don't get a dividend from it. So the lower you have in terms of real interest rates, then the better off, because you haven't got that relative bet between saying, well, if I bought US government treasuries, I can get a 4 or 5% yield versus 0 in gold. And so, it makes gold. Whereas if the yield on US bonds is only 1 or 2%, then in a relative sense, gold ends up looking better. But we've actually got bonds doing the opposite at the moment. So gold, so we've got gold going up despite US dollar strength, and bonds, US dollar bonds going up. And so, it just doesn't completely make sense. And there's definitely a lot of inconsistencies within this Trump trade. And so, or the question is, is the gold and silver, is that truly a Trump trade, or is that actually reflecting something else? And I guess that's where we sort of take back and look at, just because something's been named as part of the Trump trade in the media doesn't necessarily mean it definitely is. Okay, so that's broadly what we're talking about in terms of the Trump trade. Now, what I wanted to talk about was, what are we seeing from brokers and what are they saying about it? So I've just got some charts up of some JP Morgan. They sort of set up a two different portfolios, one with saying, okay, if Trump, a Democratic win versus which is the bottom charts, versus a Republican win on the top charts. And this is sort of showing it over since June, so it's a pretty short time frame for this. But we've certainly seen, the Democratic trades are sort of down almost 30%, and the Trump trades are sort of up sort of 15%. And so, so very much we have seen that market swing around that. Now, I do want to say as well, and they're talking about positioning in some of these stocks, but I do want to say as well, some of this might be a bit of hindsight bias. And what I mean by that is, we spoke about this sort of, gold being this, if we're worried about higher bonds and US dollar strength, traditionally that's not where you'd be selling gold, not buying gold. And so are there sort of inconsistencies in here where if you had to set this up before the fact, you might have said, oh no, that's maybe that's a Democratic win rather Republican, but because it's performed really well, it's ended up being put into the Republican one. And so, I guess what I'm saying is there's probably a little bit of hindsight in terms of this, in that here's an asset, it has gone up, therefore it must be more aligned to a Republican win, which may or may not be true. But certainly, hedge funds and exchange traded fund flows are sort of at their they've sort of changed materially. So if you went back maybe 4 or 5 weeks, that was sort of at 2 standard deviations below in terms of the hedge funds, in terms of saying more towards a Democratic win. And then now they've flipped and they're sort of 1 or 2, or they're not quite 2 standard deviations above, but they're at least 1 standard deviation sort of above prior levels. And so, definitely been a big swing in terms of the changes that we're seeing. There's the other thing that JP Morgan had on their note, and these charts might be a little bit small for people to see, but they're sort of looking at sort of tactical positioning in terms of, are people buying equities or selling equities over the last sort of the last 4 election cycles, and then what are they doing this time? And the interesting thing on this to note is that at this sort of time in the last 4 election cycles, we're going through this sort of upward swing in terms of people positioning themselves into equities. And then in the last week or two before the election, it turned pretty sharply in the opposite direction. And so, and then, depending on what happened in the election, sort of bounced or not. So not just, the problem with all these is that, a sample size of 4 is not a particularly big sample size, and really, and things change so much between election to election, but it's at least worth noting that, coming into the election for those last few weeks, people sort of get their positions and then start winding back that position as it gets closer. And so certainly this time around, you'd argue there's a fair bit of uncertainty. So, that could happen again. Then flipping to, so that's JP Morgan, some of their comments on what's happening. Goldman is, they've sort of got some of these, sort of showing a similar chart to that Democratic one, but what they're looking at is stocks in Europe that are exposed to tariffs and how those exporters, European exporters in particular, have been hit pretty hard over the last little bit. They also talk about some of the interest rate, what's sort of priced in terms of interest rates. And so what they've done is they've sort of broken their, they've looked at all the different cutting cycles of the Fed over the last, I'm not sure how long they looked at, but I think it's sort of 40, 50 years. And what they said is, well, you've got these shallow cycles where the Fed just doesn't cut very much. And then you've got these deep cycles where the Fed really does cut. So it's either you're going into like quite an economic downturn or you're having a soft-ish landing. And what they're highlighting is that, and for anyone sort of listening into the podcast, it's got a bunch of different lines on this chart, but the key ones are this, the top sort of yellow brownish one, which is saying, okay, that's a shallow cycle, and it's showing, what it's showing is that what the market's saying at the moment is pretty much pricing in that shallow cycle, and that the deep cycle is not priced in at all. And so so I guess read in what you want from that, but there's probably this argument that I think a lot of people are starting to make at this point, is that, okay, it might be that we're going for we're looking at the odds of a Trump win being much more likely than what it was a month ago, but markets are now really pricing it in as if it's a bit of a fait accompli. And so then the question is, how much further can you go? So, and to put it, I guess, in horse racing terms, for those, it's fine to think a horse is going to win the race, but if it's priced at such short odds that you think it's an 80% chance of winning the race, but it's priced as if it's a 95% chance of winning the race, and saying, well, are you really going to make money on that, or is the risk return starting to skew in the wrong direction? And that's where, that's what we're seeing. I guess that's commentary we're effectively seeing from Goldman, is that they see that downside risk. Some of the other things that noting from Goldman is, on the interest rates side, the interest rate strategist there is specifically making the comment, look, this is a binary event. It's really hard. It's 50-50. And so, and given how Trump has acted in the past, is you actually don't have a lot of confidence that what his policies are going to be post the election and what that actually means. And so, it's an event where you probably shouldn't be taking a particularly strong view in either direction. So you might want to tilt your portfolio towards what you think is going to happen, but it's hard to take a particularly strong view given all the uncertainty. On the foreign exchange, so these are different strategists over at Goldman as well. On the foreign exchange, they're basically saying, look, the US dollar versus China currency is sort of already played out in their view. What they're thinking is that, going long Aussie dollar yen or US dollar yen for a Trump victory is what they're suggesting, or short US dollar Mexico. They still think there's sort of room to run in all those trades, which is, again, that interesting one with the Australian dollar. They're putting that Australian dollar into there, similar to what we talked about before, is that Australian dollar generally benefits from positive world growth. So if you're expecting more growth from more sort of more economic growth from Trump and more debt spent to get that growth, then that's usually positive for Australia. The flip side is China's our biggest trading partner, and you would think that China is going to be the one most hit by this. And so there is a again, this that inconsistency in the effects on the Australian assets. The oil strategist over there is saying, yeah, Trump win is bullish day one, but that's similar to what I was talking about, is saying, well, maybe not later though. There's actually lots of other things that can go wrong, and so you're probably going to get a short-term effect on it, but does that actually mean that it's positive over time? And then equities, they're basically sort of talking about this last up leg in the market being due to sort of banks, small caps, and energy in particular. And they're sort of writing a lot about, they're sort of concerned about reversion and how can you sort of protect yourself from that. And also noting that I guess that a lot of their traders are trying to work out the best way to, I've called it fading a Republican sweep, but basically saying, well, they're trying to take positionings to going, well, if we can position ourselves for a Trump win, but not a Trump sweep. So what are the ones where he doesn't win everything, I guess, and it's not he ends up with only one of the houses. And so yes, anyway, that was what Goldman's saying. Deutsche, to be honest, a bit of a cop out from a lot of it. They're basically saying, well, in some ways it's cop out, but in other ways what they're basically saying is they've got big differences in opinion on the market and growth outcomes across, internally amongst their staff. And so, they've got the fiscal uncertainties, whether you get a divided government or not, that whether the tariffs ever do get applied, the medium-term effects on these supply-side policies, immigration, energy. And so, and I guess what they're basically saying is just uncertainty is so high, it's really hard to make a comment. And so they're, and one of the only things they're really playing there is just the US dollar. So bullish, so positive, the US dollar on a red sweep and negative on a blue sweep. But, saying that, making the point that, if Harris gets in, there's probably not heaps of US dollar weakness, whereas they think they want to target themselves for much more in terms of strength of the US dollar. Right, so we might just jump quickly to a quick message and then we'll come back and talk about some of the other fundamentals.
We'll be back with the investment insights very shortly. Nucleus Wealth is an active and passive investment manager. If you like what you're hearing and want some help with your investing, we can do it for you via our active portfolios. Our tactical and core portfolios use the insights shared in this podcast to construct and manage your investment. We blend tactical portfolios to offer our combinations of international shares, Australian shares, government bonds, and cash. We vary the asset allocation with the goal of protecting your capital in times of market uncertainty. We also have active international and Australian share portfolios. These are chosen using our quality and value investment philosophy. You can find out more at nucleuswealth.com. Now back to the show.
Actually, before I get to fundamentals, sorry, I did want to talk betting markets as well. Betting markets and the analytical to pollsters and what's going on there. So betting markets have very much skewed in the last little bit. I've got a chart up just sort of showing the predicted betting market, and just showing, I might bring that up a little bit bigger actually, just showing that has skewed very much in the last few weeks, from 60, so from sort of almost a 60% chance of a Harris win to flipping it around and sort of 60% chance of a Trump win at the moment. So that's the predicted market. There's another one. So without getting too much into the weeds on this one, predicted's sort of interesting in that they ask a lot of academics and there's limited, like each person is sort of limited in terms of what they can do in terms of that market. And so like the sizes are limited. And so you've got this double-edged part where the base that you're asking about this is probably skews Democratic in terms of being more academics. But the flip side is it's probably better in terms of like no one investor or no one better on these can make as much of a difference. Whereas when you looked at the predicted markets, the poly market, which is the other big one, that's sort of done exactly the same type of thing. Actually, it never really got to the same highs in terms of Harris. Like it was only ever the thought Harris was a slight chance of winning. But those ones have actually swung very much further to Trump. And but the flip side is a couple of sort of big bets on this market can actually make a reasonable difference. And the conspiracy theorists, or potentially, maybe it's not a conspiracy, maybe it's not that much a conspiracy theory, but the argument is Elon Musk making a $5 million bet, which is a speculation, maybe speculative, is him making a $5 million bet, say on Trump winning, can actually swing those odds quite dramatically around. But I guess that's sort of by the by. But it's worth noting sort of differences in some of these, just in terms of the setup and what that means. What I found most interesting in terms of these markets, though, is the three states you really need to watch from my part is Pennsylvania, Wisconsin, and Michigan. Given that Rust Belt all close together, quite likely they're going to be quite correlated in terms of if they're getting it. They're very similar areas and very similar demographics and those types of things. And so quite possibly if they'll all swing in the same direction. Like if polls are wrong or right, they'll sort of all been the same. Now, and if Harris gets those three states, that should be enough, without any other wild surprises, that should be enough to fall over the line. So all those markets, the betting markets, are saying it's a 45-55 or 60-40 in terms of Pennsylvania. When you go back to what's happening in the polling, though, and in this case, I'm going to pick on Nate Silver, who's generally pretty good on these ones. He runs a lot of models and adjusts for the polls which are done by Republicans, for example, adjusts them back to a more normal level, and then adjusts the ones run by Democrats to adjust them up, or whatever it is in terms of the bets. So all three of these markets are effectively neck and neck, and actually Wisconsin and Michigan are sort of 0.5 to 1% in favor of Harris, although that has tightened up very, very significantly recently. But the polls are still saying Harris in both those. So it's a sort of 60-40 against Harris in those, despite it saying Harris. And then, maybe high 50s, 55 to 45, somewhere between 55 to 45 and 60-40. And then the other one is Pennsylvania is 50-50. Like it's basically for the last, it's been drifting Trump, but for the last month or so, it's basically been you can't split the things. Actually, you argue for the last 3 months you really can't split the candidates on that one. Nothing's ever been far enough away to sort of point to it. So so where am I going with this? Where I'm going is markets seem to be very much pricing in a Trump win. Betting markets have very much flipped towards a Trump win. Polls are still saying very much a coin toss in all sense of the words, like it's within the margin of error. So some would argue, there's certainly been papers written and arguments that actually betting markets are, and that's why some of these other ones were set up, the predicted and some of these other betting markets were set up to actually try and harness the value of people saying, well, it's one thing for people to say who they think is going to win within polls or pundits sort of talking, but when people have to put their money where their mouth is and say, well, where am I genuinely going to put my money in terms of a win or a loss, that you get better results and better answers, and that seems to be the case. I think I sort of buy that argument from in a broad conceptual over the, when you add everything up, does that work? There have been a lot of cases though there've been enough cases where it hasn't worked to say, okay, this isn't 100%. When betting markets say one thing and polls say the other, there is, it's certainly more likely that you'll go towards the betting markets, but but it's nowhere near 100%. And you'll have some pretty high profile ones, like, for example, the Brexit vote, or Clinton the first time around, where you do see some betting markets get it wrong, quite frankly. And so I think there's when I said Clinton first time around, the Trump Clinton, Trump first time around, the Trump Clinton. And so I think there's, it leaves us in this sort of bit of a quandary from an investment perspective, is saying, well, you've got investment markets pricing one thing, you've got, which is probably more likely, but they're pricing it as if it's a fait accompli, or almost, getting close to a fait accompli. Does that mean that this sort of sets you up for disappointment in terms of that? As I said, you're talking about saying, I have a horse that's a 60% favorite, but it's priced like it's an 80% favorite. And so still the favorite, still chances, but am I going to get the return I'm expecting on that? And so we'll jump into that in just a minute, but I do want to go through some of the market fundamentals and the earnings, what we're seeing so far in the earnings season before we do that.
We'll be back again shortly. If you like what you're hearing but want a low-cost passive option, Nucleus Wealth is the first to offer passive direct indexing in Australia. The first generation of passive investing was index funds. The next gen was ETFs. Now direct indexing is here with significantly more customization and control. The benefit of direct indexing is you can add or subtract investment themes, and we have almost 100 different options to choose from. For example, you could buy an international share direct index portfolio that excludes fossil fuels and arms manufacturers and has a tilt towards cybersecurity and cloud computing. Alternatively, you could buy a portfolio with no screens and an extra exposure to nuclear power and defense contractors. You can find out more at nucleuswealth.com. Now back to the show.
Okay, so we're into a third quarter reporting season. That's off and running now, and we're starting to see companies sort of come through with their earnings. We're at the very start. Sorry, I should qualify that. We're starting to see companies, but yeah, we're really not too far into it. But generally speaking, the way it works is, so this is, most of these are US and European companies. They're reporting their numbers to 30th of September, and so the companies pretty much know what the numbers are going to be, or within a reasonable amount. And so what you typically see is analysts put out these forecasts, and then companies put out guidance, and we'll talk to analysts about their numbers and help sort of drift them into the right direction if they think there's something's different. So typically, if you're going to see some quite big disappointments, companies would be out already, because they'll know before they even hit the end of September. They're like, look, we missed our targets on July, and we missed them on August, and then we're halfway through September. We ain't going to hit our targets. Let's tell the market now. And so let's get that in early and set that bar low. So when we do actually come out with a result, we'll come out with something more likely. And so and a lot of this is sort of setting expectations, putting the bar lower. Often you'll see, people forecasting a 7% growth. Company comes out and says, oh, we're not going to reach 7. It's going to be somewhere between 2 and 5%. And then analysts all downgrade their earnings, and next thing they come out and they go, oh, we hit 5.5. And so, it's a surprise, positive earnings surprise. And you're like, well, yeah, in some ways it is, but only because you lowered the bar beforehand. And so, if you go back to the 7%, people were expecting before, it isn't it's not a beat, but yeah, anyway, it's a game that gets played. But I guess where I'm coming to from this is, we're looking at these third quarter numbers. If it was going to be a really bad reporting season, chances are we would have had a lot more negative news come out already. So the numbers at the moment are forecast. I've just got these up. I've split it between, actually, I've got that wrong. Sorry, it's actually big. I've got the big 8 actually in this one. I've called it. So it's actually the Magnificent 7 less Tesla, because Tesla actually hasn't had particularly good earnings. So better to sort of strip those earnings out. And I've also thrown in the 2 of the big weight loss drugs, because they are really affecting the earnings as well. So if you take that, you actually see that of the 5.8% growth forecast, half of that is expected to come from, or almost half of that is expected to come from just those 8 companies. And so, to just sort of try to put that into perspective about where the growth is. But the net effect is this is looking like not going to blow us away. 6% growth is not it's not fantastic, but it's way better than what we've seen, say, a year ago or 2 years ago, where we had that stock market weakness. What was happening was markets were thinking growth was going to be sort of 5 to 10%, and then it was coming in at sort of -5%. Whereas this reporting season is looking like coming in at somewhere in the 5 to 10% range. At the moment, looking at just almost 6%. So that's where we're sitting in terms of the quarterly numbers. If you look at the sort of overall view about the full calendar 2024, is that 6 months ago the expectation was that we'd come in with sort of 4.9% growth. This is global again, top 1,000 stocks, which is most of the market. And then where did we come in? Where are we looking at now? Well, it's 4.6% for the year. So there's really been very little change in terms of those numbers. Things are sort of looking a little bit better for that top 8 stocks, and a little bit worse for sort of the broader US market and say Europe is looking worse than what it was 6 months ago. But fundamentals again, nothing too concerning there. And then if you look at next year, so 2025, what sort of forecast is it's actually looking like, well, forecasts are for a booming year, almost 13% growth. And most of that's coming from US stocks outside that sort of big 8, the big 6 tech stocks plus the 2 health stocks, the 2 big weight loss drugs, which have got considerable earnings growth within them. But most of this growth is really coming from expectations. And so, and what I'm saying is look, expectations change. And at this point in the cycle, you don't put too much credence in these numbers. And you sort of, sometimes you look at it and it's actually saying, well, it's set up too high and they're only going to fail. But the reality is if we're looking at 13% growth and it comes in at 8% growth, that's a pretty good outcome for stocks. It sort of really does help bring those valuations back in again. So yes, so fundamentals, no warning signs at all at the moment within those. Well, not at all, but no warning at the top level. There's very few warning signs. Some individual stocks are having problems, but that's always the case. And then the other one is just looking at valuations. So from a valuation perspective, stocks are well above their and this is a global, I've just picked global forward earnings, excluding financials and resources. Long story, which I've put in a lot of other podcasts as to why I choose those ones. But basically, I think that's probably the most accurate measure of and most commonly used measure of what's sorry, maybe not most accurate, most commonly used measure of what people will look upon as whether stocks are cheap or expensive. And we're closing in on those highs from post-pandemic. So still not quite there, but certainly well above the 80th percentile in terms of pricing. There are some issues with this in terms of valuations. So 2 things to think about in terms of valuations is that the way that valuations can fix themselves is either you get stronger growth and prices don't move much, and that fixes itself. So that effectively what we're saying is when you see markets that are expensive, what they're actually indicating is that the growth is going to be better than expected. And that was what we saw post-pandemic, was that we had expensive markets, but the growth that came through post the pandemic sort of meant that even though we had expensive markets sort of back in that 2020 period, it was still actually a good time to be investing because the growth was great off that lower base. Now, we don't have the same lower base at the moment, but we do have relatively strong earnings, certainly relative to where we were a couple of years ago, where it was 18 months ago where we had negative earnings. So we are looking at positive earnings now. The potential for Trump certainly extension of tax cuts or further tax cuts. So yes, so lots in play, and I think there's the investment outlook you really do need to take out of this is that we've got fundamentals saying different things to what markets are saying. We've certainly priced in a lot of the positives, and if you're looking at individual sectors, they're very much pricing now a Trump win. And so the question is saying, look, if you do think Trump's going to win, should you rush in and buy those same sectors, or actually is most of the gains already done within that? And so you're looking at potentially it's a buy the rumor, sell the fact type of event where if that Trump comes through. And the flip side is the other part then is saying, well, are markets right? Is the other one is that they're very different to what you'd say to what the polls are saying, which is effectively a coin toss, could go either direction. Markets usually and betting markets more often than not are the ones that get it right, but it's certainly not in every time. And so we're very much taking this view that look, you've got to be quite discerning about the assets you're buying, and you do need to be sort of taking into account that the uncertainty is particularly high at the moment, and that what you're buying on this is you need to be taking into that uncertainty. We've still got a lot of equities. We've had a lot of equities throughout this rally. It does look like more likely a soft landing than not, regardless of which one gets in. But there's a reasonable chance that we're looking that there could be some more weakness coming before the election, and there's a reasonable chance that if Harris gets in, that you'll see some opportunities to top up on your equities as well. And so so that's sort of the broad picture. And again, I would also highlight some of the real inconsistencies in the Trump trade, in that we've got some assets going up and that don't sort of match his policies, and other assets that don't match. So for example, gold versus what's happening in bonds, really, and what's happening in bonds and the US dollar really doesn't make a lot of sense. There's the net outplay of this could be different to what might be expected, and we're looking upon this, the uncertainty around this, and depending upon who wins, as having that shopping list worth of assets, which is, look, here's the assets we're interested in buying. If they fall back to this price, we actually think these are the ones that'll benefit from it. And a good example of that is some of these renewable energy ones. If Trump does get through and we see further weakness in those, I fully expect that, we'll be looking upon that as a chance to buy in, because we do think there'll be elements where the China tariffs could easily outweigh the positives for US companies in the renewable sector could easily outweigh. I've got a whole bunch of other ones that I won't sort of say, just because I don't want to yet until we see what we're doing and when the assets do come back to the right levels. But that's how we're thinking about it and how we think investors should be looking at this event. Thanks, everyone. Just noting, you can catch us every Thursday at 12:30. Apologies for last week. Had a few technical problems and for not being on, but you can catch us each Thursday. We're going to have a bit of a deep dive in some of the income stocks next week. Just having a look at what you can look at in terms of given the volatility in bonds. There is a bit of an opportunity, I think, to lock in some yields if you're particularly if you do think that the path for interest rates, that we won't quite see the inflation and the deflation out of China will offset the inflation you're seeing from Trump, and especially if you think Australia is more at risk from a weaker China. And so so more on that next week, 12:30. Look forward to seeing everyone there, and you can get us on all the major podcast platforms. Thanks, and we'll speak to you next week.